So, welcome to our version of our market update on this podcast today. We really appreciate you participating, and I've got a special friend of mine, Shayan Salahuddin, joining us. He is a market expert with Integrity Home Mortgage, and I just love hearing what his insights on the market so that we can help best educate our home buyers. So, welcome.
Thanks for having me.
Absolutely. So, so first, let's go ahead and dive in. One of the things that we talk about a lot is, okay, we got to see the jobs report and all those kind of things. So, how do things like the jobs report and comments from the Fed, things like that, affect rates? And then what impact could those things have on rates long term versus short term?
So, what's happening right now well, let's boil it down to the most basic thing is that rates right now are very sensitive to actions by the Fed because the Fed is in the process of acting right now, right? For a while they were on hold, and now they've got it. We have a Fed meeting coming up just in a couple weeks where they are expected to get back in the business of cutting rates. So, why are they cutting rates? Well, there's two things the Fed keeps their eye on, right? Their mandate is to provide price stability, right? So that means battle inflation and to create an environment in which full and maximum employment can be reached, right? So preserve jobs and fight inflation. That's their mandate. And so when we get reports that talk about inflation or jobs, the Fed pays very close attention to those things because that provides them their roadmap on what it is they're supposed to do. So recently, what we've seen is inflation going in the wrong direction a little bit, but at the same time, jobs also going in the wrong direction. Right, so job markets are cooling and inflation is going up a bit, and so the Fed's in a position where they have to make a choice. Right, do we pay more attention right now to inflation or to jobs? Because if we pay attention to inflation, the Fed might want to raise rates, right? Because inflation's getting a little higher. If they want to prevent job losses, they want to lower rates to try to spur the economy. And so that's why these reports are so very scrutinized by everybody in the marketplace. I think right now the Fed has made it fairly clear that they are more interested in preserving jobs right now because inflation is not as out of control as it has been in the past. So right now we're paying very close attention to jobs. Jobs report will come out this coming Friday, and a bad number there would maybe entice the Fed into cutting a little faster. A good number maybe allows them to sit back for a little bit further, for a little bit longer, and say, all right, well, let's see what happens with future jobs reports, and let's keep rates high in order to battle inflation. We'll see.
Okay, so how often do these reports come out?
So generally speaking, each report comes out about every month. It depends on the report that we're talking about. Right, as it relates to jobs, the big number is what we call non-farm payrolls, right? And so it is that the first Friday of every month, and that's where we get our unemployment rate from. That's where we get sort of the official number of how many jobs that were created across the economy in the country. And that comes out, as I said, the first Friday of every month. As it relates to jobs, there's also several other reports that come out over the course of the month from different places, right? Some are government created, some of them are created by private companies like ADP and Challenger, which are big employment, like payroll processing and employment companies. So you get information from all sorts of different places, but generally comes about once a month. As it relates to inflation, there's a whole lot of different numbers that happen out there, right? There's producer price index, which is a big one, and that measures inflation at the wholesale level, right? So wholesalers, so basically producers of goods, the type of inflation that they are experiencing, because the thought is eventually that will make its way down to the consumer. There's CPI, or the Consumer Price Index, which is a measure of consumer inflation, so the type of inflation that you and I are experiencing. And then there's another number called core PCE, which is the Fed's favorite number to look at, and that is essentially a measure of maybe a little bit more of a holistic measure of consumer inflation, removing out some volatile components like food and energy. And that kind of gives them an insight on the type of inflation that they believe can be influenced by by fiscal policy, monetary policy. And so that's what they look at. So again, it happens about we get each report about once a month, but in aggregate we get something like every week, right? Sometimes several things a week that seek to measure those two things, which is employment and inflation.
And when I watch the markets, we can tell in a day where they come out because the market kind of opens slow and sometimes there's a big swing and sometimes there's not. So you never
Yeah.
know.
Yeah, if you get a
Um,
number that comes in right on top of where people expect it, you shouldn't expect to see a swing. Sometimes you'll get a number that comes in that is outside of what expectations were, and then the market invariably reacts, right? This important data, it tends to come out pretty early in the morning. Most of these important reports come out at 8:30 in the morning. So when you're having your morning coffee and you're seeing something going on, right, the market's going way up or way down, it's normally because there was a release right around 8:30 and markets are reacting.
all right. So, I mean, we all know that, well, I know, I've learned that necessarily the Fed cutting rates doesn't necessarily mean that mortgages are going to come down. Can you explain that kind of correlation, why those are different?
Yeah, that's a really good piece of insight and an important thing for folks to understand. The Fed, when we talk about the Fed cutting rates, the Fed has a direct control over just one type of interest rate. It's called the Fed funds rate, and it's the rate at which banks are able to lend money to each other on overnight loans, right? So overnight interest rates that are directly correlated or directly impactful to banks. The rest of all interest rates that are out there, right, whether you're talking about credit cards or automobiles or student loans or mortgages or your credit, any type of credit that a consumer might take, all of those rates are really governed by the markets, not by the Fed. Now, the Fed does have some influence, right? As the Fed is pushing rates down and pushing rates up, it impacts the rest of those types of lending rates, but they don't control them at all, right? And the further out you get in time, right, like a mortgage, for example, is a 30-year loan. It has less and less correlation to what the Fed is actively doing, right? So the Fed, let's look back to last year around this time, right? So in the fourth quarter of last year, the Fed cut Fed funds rate by 100 basis points, right? They cut by 50 basis points, and then they went two more times before the end of the year and cut 25 basis points each time, right? So a total of 100 basis points in rate cuts. Do you remember what mortgage rates did at that same time?
They did not go down.
No,
They
they
went
went
up.
up. In fact, they went up by 105 basis points. So you'll see it went the opposite direction, and it went the opposite direction in a pretty fantastic way. And why is that? Well, at the time, we had kind of a similar dynamic as we're having right now, right? We had the Fed that wanted to do some action, right? Because they felt like perhaps it was time, and the overall economy was giving them an opportunity to do so, right? Their goal at the time was to come back to what they call a neutral rate, right? A rate that isn't restrictive but also isn't stimulative to the economy. And so they cut rates, but at the same time, we still had some lingering concerns. We, as an economy, had some lingering concerns about inflation. So the inflation had still not hit the Fed's 2% target, but the Fed was going to cut anyways. And as a result, the Fed cut rates, and people felt like, well, if you cut rates, that might be stimulative, right? That would get people spending more because it's cheaper to borrow. And so that would exacerbate the inflation issue. And so investors feeling there might be increased inflation, then demand higher returns the further out they invest, right? Because inflation should, over time, create a situation where interest rates are higher. So they're going to price that in today. And that's kind of what you saw last time. And that is sort of analogous to what we're going to see, that we could see today, right? The Fed is cutting rates, and there's still some lingering inflation concerns. Now, this time's a little bit different in the sense that we are we are undeniably seeing some early signs of some slowdown in the economy, right? We're seeing
Yeah.
some signs of lower job growth, lower hiring rates, increased unemployment. And so with that, maybe there's enough there to offset the concerns about inflation. But the punchline here, right, the moral of the story is the Fed could be cutting rates. That does not mean that long-term interest rates, specifically mortgage rates, are going to follow. In fact, we've seen in the very recent past just the opposite. And as it relates to long-term interest rates, those are set by the market, right? Not by the Fed. So if the world thinks the Fed is going to cut next month, the world will in fact price that cut in already. And so that's what we've seen happening over the past 3 or 4 weeks, when markets markets have expected the Fed to start cutting based on the last jobs report we had, right, which was a month ago today, right? It was 1 month ago today. We had a bad jobs report. That bad jobs report got the world thinking that the Fed would cut next time, and that's why we saw interest rates fall about a month ago. Now, we've been at that same level for about a month now because the world thinks that the Fed is going to cut rates next month. So if the Fed cuts rates, this month, if the Fed cuts rates this month exactly the way the market anticipated, well, nothing should happen because we've already priced that in. So waiting for the Fed is really to no avail, right? At this point, the Fed can really only disappoint, right? If the Fed comes in later this month and say, well, you know what, we're not so sure this is the time to cut, then that entire improvement in interest rates that we've seen over the last 3 or 4 weeks will go away. We'll go back to the higher rates that we had about a month ago. And if the Fed comes out and says, yes, now's the time we're going to cut, but we've already priced that in. So there's really only downside at this point. You don't want to wait for the Fed. The Fed's always acting on a lagged basis because they only get a chance to cut every 6 weeks. But the world, right, the investment community is out there trading these things every day, right? We're pricing these things every single day. So the minute the world thinks the Fed is going to cut, they will price it in on that day. So when that happens, that's the time you want to act, which is right now, not in 2 weeks when the Fed meets.
Yeah, so moral of the story is quit waiting for the Fed, and what the news people are saying is the appropriate time to buy a house, and go ahead and do it today. Talk to professionals that know these kind of things. Take the time to learn it, because really timing the market, I mean, Warren Buffett says it. You can't time the market. You just got to do what's right and stay consistent. So, and mortgage bonds can be up and down, and they have been lately.
They really have been. I mean, it's been a historically volatile time for mortgages, which makes it all. I mean, your advice is absolutely sound, and it's no more relevant than it is right now. Right now, with the volatility we've seen, when you get an improvement in rates, it's a great time to act because there is no guarantee that there's more improvement to be had, and this improvement that we realize could vanish tomorrow.
Exactly. And I mean, this is where we talk a little bit of strategy about taking advantage of what's good now, and so that we don't know what's going to happen in however many months, because we've been told for what, 2 years, 3 years, that rates were going to drop down to the fives. They're not there yet. Um, so we're still waiting, but let's move on to some of the other, which is probably some of this volatility. So, well, I've heard so much and I've had so many questions about the big, beautiful bill. And people are telling me that because of perceived notions and everything with it, it's affecting mortgage and real estate markets. Have you seen this? Do you?
I mean, I think there are things that are potentially impactful, both positives and negatives, out of the one big beautiful bill, right? We have Some things that are potentially positively impactful are deductions, right? So the mortgage insurance deduction. This bill reinstated those tax deductions for mortgage insurance that you pay, whether it's private insurance or government insurance on your FHA loan. Those deductions are back now, and that's a potential savings on average, I think, of around $2,000 per
Yeah,
year for buyers. The SALT deduction, right? SALT tax, state and local tax deduction. The cap on that went from 10,000 to 40,000, which is impactful positively to incomes in general. Whether that translates to spending on housing, who knows, right? But the fact of the matter is that there is more deductible or more disposable income for certain individuals. Now this is particularly impactful to higher wage earners and that live in higher tax areas, like the DC area, like New York, like places like that. There's going to be much more impact there, but there's some impact regardless. Mortgage interest deduction, right? The deduction of mortgage interest that you pay, that has been made permanent, which we've had that for a very long time, but it's nice not to have to worry about that anymore. And then any tax cuts that were temporarily put in place back in the 2017 tax bill, those were made permanent. Now, on the real estate side of it, right, on specifically as it relates to house prices, there are several portions of this bill that were directed at that, but they really are a little bit more focused on landlords and developers and things like that, which is good for the overall housing market because we do have a shortage, right? And there has been a shortage of housing for many, many years now. There are things in the bill that will hopefully spur new development, more development across the country, which is something that we are behind on it as a country and have been for a while. So increased supply will perhaps make home affordability a bit better and home attainability a bit better especially for first-time home buyers. Now that's a little bit longer dated, right? Those developers really have to build those houses first before they can sell them. But I think there's a runway now that has been put in place in order for that to make that a possibility. So positives in certain areas, negatives in other areas, but in general, the fact that there are some provisions around here that seek to spur either borrowing or real estate development, I think are both positives because it's an area that has been ignored for, frankly, far too long since since the global financial crisis.
yeah, absolutely. We're seeing more homes are hitting the market, but there's still a shortage. There's not a lot of my pre-approved buyers still can't find what they need slash want because there's just not enough to go around, even though more homes are hitting the market or they're not in the right price point. So that growth from encouraging developers to develop and stuff can really help that. Also, good note on the tax thing, tax cuts. So if somebody is wanting to maybe find some more disposable income, that could be a great way to pull in their CPA, figure out how to make that work, get a little bit more of that disposable income, and that can help with home affordability, especially in those higher priced areas, like you mentioned, because taxes and insurance are causing a lot of people not to be able to afford homes right now. So taking advantage of that, getting your tax professional involved to help you strategize can be a huge asset for you. And so that kind of takes me into my next question, home affordability. So every time I turn on the news, the radio, or look on one of these news feeds while I'm looking at markets, I see that there's a home affordability crisis. Um, where is a lot of that coming from? Is it sensationalized or is it really the crisis that they say it is?
I think it's a little bit of both. The media is always prone to sensationalizing everything. That tends to hit mostly in the headline. I think if you read the articles all the way through, there's generally speaking a pretty decent and balanced assessment of real estate. What we have to realize is that real estate is not a monolith, right? Not every house across the entire country, not every market across the entire country moves in the same way, right? When you're talking about real estate, it is really, it varies from, you know, zip code to zip code, from block to block, from street to street sometimes in certain areas. And so, ultimately, paying attention to the media, right, and national coverage when you want to get information on housing markets is really a great way to confuse yourself. You don't care as a consumer of housing what's happening in the country. You only care about what's happening in that little slice of the country that is your particular market, right? In your school district, your targeted zip code, your targeted neighborhood, right? That's what you want. So, if you really want insight on real estate as it relates to you, what you want to do is, seek the advice of someone who knows, right? Seek the advice of a Kellie Collins. Seek the advice of your particular real estate professional in your market to understand. Now, what we are seeing in terms of national trends really is a bit of a slowing, a cooling market versus what we've seen over the past, 5 or 6 years, right? The last 5 or 6 years have been very, very good to homeowners and not so great for prospective first-time home buyers, right? Every time you look up, your dream home got more and more expensive if you are looking to get into the market. If you are already a homeowner, what we've seen is growing equity, which is great for you.
Yeah.
And there is, we've gone from double-digit annual increases in home prices down to low single-digit annual increases in home prices in the last couple of readings. So home prices are still advancing, right? Things are still getting more expensive, but they're getting more expensive at a rate that is really much closer to inflation, which historically is kind of the trend, right? Home prices
Yeah.
tend to just barely outpace inflation over time. And so what I'd say is home price appreciation has gotten to a point where it is still positive, but positive at a much more sustainable rate. I know that there's a lot of folks out there that kind of still have memories of what happened in 2008, 2010, when we had the global financial crisis, and home prices in a lot of areas of the country just fell through the floor, right? And you could buy houses for just a few bucks, and foreclosures were happening left and right. And with the housing shortage that we've been experiencing over the past several years, I think it's a pretty far-fetched notion that we would get back there, right? The underwriting, the quality of the underwriting in mortgages has gotten better by leaps and bounds, right? We're not making we haven't in the past 20 years or so made those kind of loans that are layered risks, right? No income, no documentation for first-time home buyers on investment properties, right? Like that sort of lending just hasn't happened in a couple decades now, or maybe a decade and a half now. And so there's much stronger credit behind homes. There's a lot fewer houses out there, and those houses that are in people's hands have a lot of equity, and they're financed at very low rates. These are really great investments for people that own them, and they are not going to just put the keys in the mailbox and walk away this time. So housing in general, I think, has some very, very fundamentally structured support underneath them. So I think that housing is really, going to be well supported for a very long time in this country. It'll take us a very, very long time to develop more housing, and rates are still, fairly sticky, right? I mean, we've been in this sort of 6 to 8% range for 3 years now, and historically speaking, that's about normal, right? If you take out the last 15 years that were sort of artificially propped up during the global, in the wake of the global financial crisis, and then COVID, right? People got used to the notion that there were going to be 2%, 3% mortgages for the rest of their life. That's not normal. That had never happened before in this country, and it will likely never happen again. Fingers crossed, because we don't want to go through another COVID or
Right.
another global financial crisis. But if you look at where rates are today, right, in that sort of mid to high six-ish area, very, very normal. So these, people talk about, how high rates are, how high rates are. The media talks about how high rates are. Rates are not high. Rates are average right now. This is a good time to get in. Home prices are still getting higher, and every day you wait, that home that neighborhood that you love, is just getting more and more expensive. It's getting further, further out of your range. So it's never a bad thing to finance a home at an average rate, which is where we are right now, especially if a good loan officer that can help you refi when things get worse or get better, right? When they economically get worse and rates get better, you can always refi that loan and take advantage of low rates when they come. But if rates do get higher, because they have and they could in the future, you're going to be really, really happy with the fact that you are in that home at an average rate today.
Well, and so I spoke with a group of realtors last week, and we talked about a couple things with this. Is that one, over the last 74 years, real estate, including that 2008 section, has only lost value 7 years out of 74. So historically, real estate is one of the best investments you can get into. It's also one of the very, very few where you can start with a $20,000 down payment and 5 years later walk out with $100,000. Like that is a huge return on your investment, and there's almost nowhere else that you can find that. Um,
So along the way, you've been realizing tax benefits. So you're really walking away with significantly more than $100,000 all told. But there really is no other investment out there that is available to the average guy, right, or gal, where you can come to the table with $1 and somebody will lend you four, right? It's a really efficient way to build wealth and realize tax benefits, and oh, by the way, have a place to set up roots and raise a family and live your life. It is both utilitarian and economically positive.
It's so great. And I mean, the home affordability thing, I mean, people can still afford homes. There just has to be a little bit of strategy behind it. Maybe it's saving money for a down payment so that you're not having to take on excess fees of 100% financing. Maybe it's even negotiating the contract appropriately so that we can have the seller pay for a lower rate for you. Those are all strategies that I work with a lot of my clients to help figure out the best strategy to save you the most money so that you can really use real estate to meet your goals. So it's a great thing to just don't just look at real estate as a or mortgages as a commodity. They're a tool to help you advance your future.
And I think one of the things that a lot of people don't understand is that uh, there are so many tools out there to help you improve your credit, to strategize around how to make things that are seemingly unaffordable more affordable through different products, through different avenues, and it can be overwhelming. And so the first thing that you should do is, rather than spinning yourself in circles around all the different things that could happen, right? Reading things on the internet and pursuing a thousand different strategies, you reach out to your financial professional, right? And you ask them what the most efficient path to fixing your issues are, right? To overcoming your obstacles, because you really only need to take advantage of a couple of those strategies, and they will be hugely impactful to your particular situation. And there are thousands of them out there, right? There are thousands of strategies that you could pursue. You really only need to pursue one or two. So the first thing you should be doing is picking up the phone and having a conversation with that person that you both trust and that you trust knows what they're doing. And so that is the advice that I give to all of my families and all of my family and all my friends when they're first getting into the process of doing anything large financial purchase related, especially a home.
Right, absolutely. Um, all right, so one more question and then I'll let you go. So, there have been lots of talks of trigger leads. So, for those of you who don't know, when I am working with a client and I pull in a credit report, there is a very, very good likelihood that within minutes, your phone will start blowing up with text messages and phone calls with other people trying to offer you mortgages, claiming that they are going to beat me no matter what. And I didn't sell that information. That's something that comes from the credit bureaus. It's one of their streams of income. So there's actually a bill that has been introduced that is trying to limit the fact that you're look shopping for a mortgage. So where are we on all of that?
So the bill we're talking about is HR 2808, and it is called the Homebuyers Privacy Protection Act. And it seeks to do exactly what you said, right? Rather than having 1,000 phone calls come every time you come, come into your cell phone every time you, try to do anything, right? Take out a loan of any sort. It seeks to whittle that down where only people who you want to do business or have done business with in the past are able to contact you. So rather than getting spammed by all sorts of folks out there that are just buying leads, you're going to get calls only from people that you know, right? People you've done business with in the past or that you are currently contemplating doing business with. This bill is really, really rare these days in the sense that it has bipartisan support. It's been passed. I think it's still waiting the president's signature, or it's either that or it was just recently signed. But one thing you should keep in mind is that it does have a 180-day implementation period, right? So there's some time that's been afforded to the industry to basically change their practices and put in place the technology and the systems they need to make sure that they are calling when it's appropriate and not calling when it's not appropriate. Right. And so that's really basically it. It prohibits the sale of these trigger leads by the credit reporting companies. It provides an avenue to consent to being contacted by pre-existing relationships. But the real crux of it is it shifts the burden from the consumer onto the solicitor, right? So now instead of the consumer having to go out and block everybody in the world from from trying to call them, it makes it incumbent upon the solicitor of that business to say, yes, I know this person, they trust me, and so I am able to contact them. And that's a much better place for all of us as consumers to be, right? I shouldn't have to protect myself in from all sorts of different threats that are coming from places that I don't even know of, right? It should be incumbent upon the people who are stand to make money off the transaction, and that's what it's hopefully going to do. So it is not in effect today, so you're going to want to talk to Kellie and understand once you're in the marketplace for any sort of financial transaction. She can teach you how to protect yourself today, but hopefully in a couple months that'll no longer have to be a concern.
Absolutely. It can be very frustrating while we're still sitting at the table. The phone starts blowing up, and then I mean, it's frustrating. I remember when I bought my house and I got my credit pulled for a mortgage, and I'm a loan officer, and I had to start blocking phone calls. It was crazy.
Yeah,
So,
so
um,
frustrating.
but we're moving in good strides to really protect our customers, improve everything about our industry. And that's what I'm here to help do as well, is really help my clients' friends and family do the best they can for themselves. And I truly believe buying a home is one of the best routes. I have run into a lot of senior clients lately who are getting priced out of rentals right now, and they never bought a home. So my recommendation is start early. If you have a good income, talk to somebody about the strategy to buy your first home. You can buy your first home as soon as you can write a contract. So let's start that strategy early. Let's get your financial advisor involved, your CPA involved. work as your team. Look at your mortgage, look at your financial situation at least once a year with your advisors so that you can really understand the market, where everything is going. And I mean, we're not all as smart as Cheyenne, but you know what? We can all learn a little bit of something and get great advice so that we can help grow our portfolio. Real estate is one of the best ways to build wealth in history, basically. And so using it as an access anybody can access to build wealth is a great thing. Let us know how we can help. And do you have any other final words?
I'll just echo what you said, right? I know this area. This is something that I'm an expert on, but I also seek advice from experts in places that I don't know as much. So talk to your financial professionals. There's never been a more important time to do that than today. The tax code is more complicated than it's ever been. There's more tools available, but the entire economy in the United States is set up to allow folks to pursue that American dream of home ownership. You may not think you can qualify, but a lot of folks do that don't think that they can qualify. So
Absolutely.
get some advice. Home ownership is a lot more attainable than most people think.
Perfect. Thank you so much for joining us today. I really appreciate it. And we look forward to having our next conversation in a few months.
Absolutely. Thanks, Kelly. Have a great one.
Thank you.